the return of capital, then the return on capital, cash flow oriented, right? Relative value, discipline, patience. That has 100% shaped how we do things here at Kane Anderson.
Welcome everyone to another episode of What's the Alternative, where we talk to portfolio managers and investment professionals about different strategies in the alternative investment space. Today we have for us a great guest from one of our newest platform partners here at Monrian. We have David Selznick from Kane Anderson Real Estate. He is the Chief Investment Officer at Kane Anderson and also sits on the investment committee and the board. He is the individual who really drove the beginning of Kane Anderson's real estate platform and specifically has expertise in medical and senior housing. So we're really excited to have David with us today. We've done a lot of discussions about real estate, but we haven't really talked about commercial real estate and industrial, medical, any of that. It's been residential and the debt side. So we're excited to have you with us, David.
Great to be here.
So why don't you tell us a little bit about your background, how you got into this space, where you kind of cut your teeth as it pertains to real estate investing, and we can dive into some of the great things that Kane Anderson is known for.
Sure. So one, I'm from Cleveland, Ohio. So being a Midwesterner, culturally, we're win-win people. We actually believe that zero-sum transacting is not the way to do business, and that you can actually be thoughtful and transparent where both sides can have a win. And I've sort of my whole life, I've sort of feel like I've been super lucky. And it sort of started as a kid. My best friend's dad, he was a real estate guy. He owned a bunch of apartments and some retail centers. And so, me and my close friend, we painted his apartments, we schlepped, we landscaped, we moved appliances. So that it was like a good experience to be in the apartments doing work as a laborer. But, when we would come home and talk to his dad about his job and what he does, and a few things that as a young person were pretty telling. The first and foremost was he seemed to have a lot of success. He would travel, and I'm like, man, this is pretty cool. And he said, yeah, when you buy these properties, yes, you have to operate them, but think about it. You could be, in Paris having dinner with your wife, and people are paying you rent. I'm like, that's pretty good. I love that idea where someone can pay me rent so I don't have to work an hour to earn an hour, right? That like as a younger person, I'm like, I want to do that. And then the other thing is that the importance of cash flow and how cash flow is a big mitigant to risk, right? If you can generate income and grow income over time to the things that you own and operate, there's no better mitigant to your sale price or your, anything that happens between point A and point B. Because when you buy a piece, stock, or you buy something that doesn't generate income, you're solely dependent on where you sell it at. So that simple idea of, hey, if I own something for 5 or 10 years, if I cash flow, they call it 8 to 10% a year. After 10 years, my whole investment, right? I've gotten all my money back through cash flow. So that sort of idea really sort of shaped sort of how I think. And then when I went to school, I went to business school. I had a master in finance. I took I was a JD. It was really a master's in real estate finance, but like I went to school for this. Now, I didn't know what I would ultimately do. I started out working in real estate banking, but I really modeled my educational, from my friend's dad. He was a lawyer by education, not by training, or not by, his profession. And so the way you think, the way you communicate, that all was shaped during, my schooling. And then I was in banking until the GFC. And then in '09, I left, started my own investment business. Very low opportunity cost. I had my wife and I were just married. I had a dog, a mortgage, no kids. And in banking, nothing was happening.
Mhm.
As you remember, I don't know if you were
Oh no,
around then. You look.
I was. I actually cut my teeth on the alternative side. I don't know why I'm
Oh,
using
is that
that
right?
phrase a lot all of a sudden, but yeah, I started my journey in the alternative space during GFC. I was working for Russell Investments hedge fund of funds as a quant analyst on the equity side, and
Okay.
started there in July of 2007, and
Okay.
went through the
I knew
highs
you're
and
younger than
lows.
me. Right. I knew you were younger than me, but you had a couple years before it all sort of was the most surreal experience. Well, all of us, you'll never forget where you were when Lehman went down,
Yep.
right? Um,
Exactly that. I've been in the business since the tech bubble burst. So that's when I started. But exactly
okay.
right. I remember exactly where I was when Bear went down because that was the day I got laid off from Russell, and then I know exactly where I was when Lehman melted down because I was working for an RIA outside of Boston. And all of a sudden, that's when all the media that I do became such a big thing. I was contacted by one of the local TV stations to come in and talk about what was going on. That was what, September of '08.
Yeah. Mhm.
And I remember being on a call the Friday before with a really famous portfolio manager from Loomis Sales, and him talking about how everything was going to be okay. And then coming into the office on Monday and like the whole world had ended because Lehman kind of went under over the weekend.
It was unbelievable,
Yep.
right? And so, we when we think about those experiences, and I started my own business, and fortunately, things worked out really well. I met so many of the people that I do business with today during that sort of that '08 to 2012 period of
Mm-hmm.
time. And I joined Kane in 2012. I really spent a lot more time with Al Rabel, my partner, during that period of time, as he was really launching Kane. We looked at a lot of stuff together and so forth. But that imprints in your brain how downside protection is so important.
Yes, that's why I always talk about. That's when I became like, a preacher for all things alts, an evangelist, if you will, because of exactly that reason.
Exactly. And so, like, the utilization, how you utilize leverage, how do you make this investment decisions, the return of capital, then the return on
Yep.
capital, cash flow oriented, right?
Mm-hmm.
Relative value, discipline, patience. That has 100% shaped how we do things here at Kane Anderson.
It's really interesting you say that because you're talking about it as it pertains to real estate, and that was a really advantageous period to get into, to have your own investment firm focused on real estate because real estate was kind of one of the key drivers of the GFC, and everything just got repriced, and you could
For
jump
sure.
into the market and have these really fantastic investment opportunities that were trading well below their value because the market just imploded. And I didn't touch real estate at that time, but I actually made a ton of money with a bet on MLPs for the same thing, cash flow oriented,
Sure.
um, you know, really beaten up. Everything was repriced. Almost all of it was trading below net asset value. And so you could just make a killing on it. And real estate was another place that is. So your timing was impeccable, even if at the time it probably felt pretty scary.
Well, I will say, one, Kenny Anderson, they're big. We've been big MLP
Yep.
investors forever, so for sure, and that's where the value orientation. That's one way to have, that value manifested
Mm-hmm.
itself for sure. In real estate, um, it was clear if you can get something done, you were going to win.
Yep.
You just had to get it closed, right? And so, I was doing a bunch of smaller things, some non-performing loan portfolios, senior housing here. I bought, 5 or 6 apartment buildings, smaller value add type deals. And then the bigger deal that during that period of time was in early '09. I started working on this 600 unit apartment complex. I lived in Chicago, and I very early concluded that the seller was nuts, and there was no way he was out of the money. I had to go to the lender.
Mm-hmm.
So after months of dealing with how to get to the loan, how to get to the lender, I finally was able to get to the lender and figure out how to get it under agreement. It was a class F deal, maybe D minus, okay, but in a B plus A location, great location. But the previous owner just let it go. It was terrible. So, but we were buying it for 20,000 a unit.
Wow.
So anyhow, long story short, 3 days before closing, I had my money, my uncle's money, and when I say my money, I had it was everything but $10,000. Okay.
Mm-hmm.
My wife had no idea what I was doing. And this deal was too good. My uncle, he and I were hard money, $1 million. And 3 days before closing, my partner, so I had a money partner, they walked. And so my main LP said to me, okay, I'll lend you money for 90 days. You take no fees. I know you could do this. Make me proud. 88th day, replace my GP partner. The deal ends up being a 4X. But there was a 90-day period where I thought I might have lost all of my money and my uncle's money because I had to find a replacement for the guys who left me at the altar 3 days before closing. So that was that time period. If you could get it capitalized, you were going to win. But it took everything and then some to get these things closed. So anyhow, so that was that time period. And then I joined Kane in 2012. We had 750 million under management. We were primarily student housing. Al and I see the world the same way, downside protection oriented. And then we wanted to build this all weather business that was relevant and active and outperforming in all cycles. The way that we're going to do that was through not only equity, but at a debt business over time, diversify not into a generalist, but as an alternative investor in low correlated sectors like student housing, right? Good times are bad, people go to school. Senior housing, good times are bad, people need homes, senior homes to live in. Medical office, same sort of thing. Self storage, light industrial, these sorts of things have a lot of resilience that are not correlated to the broader economy. And if you look at demand, which this is a very important point, in real estate, being a demand-centric investor is critical because supply is inelastic. You have surges of supply from time to time, but if you have robust structural demand, that supply will get absorbed over time. It may not be, as you anticipated, but the binary element is not there because demand will always help you through any kind of supply. If you have a one horse town or a two-horse town or anything that is very episodic or has, like, for example, when there was this big fracking boom in the Dakotas and parts of Texas, there needed these apartment buildings for all the workers. But if you thought about it, what if the efficiency started to increase, or what if the oil reserves became much less, right? You would not need those apartments. And so what happened is that was very binary. The need for those apartments dropped off a cliff, and because of the efficiency and technology, they needed a fifth or something like that of the workforce. So we stay far away from those sorts of things, and we focus on apartments across the street from University of Michigan, Wisconsin, Florida, those sorts of things, right? Healthcare systems that you go to the doctor, you need a knee replacement, you need, any kind of cardiovascular services, oncology, those sorts of things. That's what we do. And we do it through our opportunity funds. We do it so that's your, two times your money, 20% returns. And then we have an open-ended core fund, which is low leverage, long-term, 10% returns. And then we have a debt fund series where we're making loans and buying loans, all in the same downside protected, low correlated sectors. And so, that started in 2012. Fast forward to today, we went from 750 million under management to, we're 18 million under management today in these things that we do. And I will say when, times like, when COVID hits, right? When COVID hit, we weren't on the sidelines. We were leaning in, and we bought or we bought or lent money on 5 billion or so of real estate. So anyhow, that is how we built this business to not only be all weather, but be able to really lean in times of dislocation. And so these sorts of markets today, when you have so much noise about tariffs, geopolitical risks, all those sorts of things that creates some inefficiency or illiquidity, that's when we're at our best.
I'd like to learn a little bit more about opportunities today. So we talked about the financial crisis, and you talked about how you approached the market then. And again, that was early on in your career. And, obviously you have a vast more resources, capital, and experience behind you. And talk a little bit about opportunities today, because I think a lot of people and a lot of our listeners, residential real estate, everybody kind of understands because we all need a place to live. But you guys really work in markets that aren't necessarily the ones we talk about so often. And in a world post COVID where the real estate markets are really different than they were pre COVID, where are you finding opportunities, and how do you approach your investment decisions and potential investment opportunities for the funds that you are managing?
So a couple things. One is it's really important in our businesses, right? The fundamentals, this supply demand thing, right? Um, that has never been this strong. So when you think about, how our population is aging, right? The baby boom generation. All right. So there's, when you think about the needs of that cohort, they need a lot more healthcare, right? They go to the doctor 4 to 6 times more than the average American, depending on the age. They start living in senior housing. In fact, the 80 plus year olds are growing at, 5 times as fast as the rest of the population. So when you think about all that demand, right, and then the supply is quite constrained because it's expensive to build, right? Lending, the tariff noise, the cost of construction. So you have not only today, but the next 5 to 10 years, you have these surges of demand without nearly enough supply. So that feels really good when you think about the fundamentals. And at the same time, same thing with student housing. I mean, student housing at these major schools, you have a ton of demand. You ask anyone with kids applying to schools today, it is super hard. There's so many kids. The enrollment numbers at these big state universities continues to go up and up. Meanwhile, the amount of land available for development keeps going down and down. It's like, think about an island, right? These campuses are like an island, and you want to be walkable to these campuses. So there's only so much land around these campuses, and that's what we build and buy, right? So when you think about these things, today, you have all these strong fundamentals, very low correlated to the broader economy. So no matter what happens with the stock market, people still need to live in these homes or go to the doctor. And there's inefficiency in the market. So our ability to buy at attractive pricing is better today than it was, before COVID. And certainly, 2021, 2022, before the Fed started increasing rates, that was super competitive. We were very patient. But now our currency, our strength, in buying, we're one of three groups that are as big and have the capabilities that we have because this is, again, the only thing we do. So you have strong fundamentals that have not been this good, and where the next 5 to 10 years are going to be incredibly strong. And then you have the ability to buy at better pricing, right? So when you think about it, this environment could be better for us.
Yeah. Can you dive a little bit deeper into, say, medical office properties and senior housing? You did touch a little bit about 80-year-olds and how the needs of that generation, the baby boomers. I read somewhere recently that there's not nearly enough. There's like a 3-to-1 ratio of folks that are in that age cohort to available housing opportunities in senior housing facilities. Is that true? And talk a
That
little bit about the
yeah.
cash flow scenario and how that works as far as an investment goes.
So and let's just focus on senior housing for a
Okay.
minute. So everything we do in senior housing is private pay. So we don't have to worry about Medicare or Medicaid or anything like that, right? The other thing is these are higher end deals. This is like a country club. This is like cruise ship on land. This is like going to the Four Seasons, generally speaking. Some are Four Seasons plus, some are, Conrad.
Mhm.
You pick the flag one step down from Four Seasons, and a lot of these places are the spectrum. So it's independent living, people driving and doing whatever they do normally between ages of, call it 78 and 85. And then you have, assisted living and memory care
Mhm.
as a continuum, so that if this the husband and wife, one needs more care than the other, they can be at the same
Yep.
property. That's very important. And so the cash flow and the demand, our leasing has been great post COVID. I mean, COVID was super hard on senior housing. As you can imagine, you couldn't move anybody in,
Mhm.
right? The regulations didn't allow you to move anyone in.
Right.
So it's been basically a massive lease up since then, plus all the demand that you're sharing. So we're seeing, 6 to 10% rent growth, in some cases close to 15. Our occupancies are up, 10% over the last 2 years. So it feels really good as far as from an operation perspective, generating cash flow, all those sorts of things.
Okay. So I I definitely understand what you're saying. I see more and more of those. Like, I live right outside of Chicago, and in Evanston, there's a really high end senior housing facility that looks like a hotel. Has like a
Yeah,
doorman and a concierge, and like you would drive by it and think it was a hotel, not a senior housing facility.
that's right. It's very hot. These newer buildings that we've built or bought are very hospitality oriented, multiple dining activities, wellness, spa. I
Yep.
mean, these places are super nice.
Hmm.
And so for those who can afford it, it's been a huge adoption rate um, from the folks who are getting to that age, and adult children through COVID, like, hey, this is not healthy. You not being alone is not good,
Hmm.
right? The lack of socialization is actually the number one cause of accelerated aging.
Hmm.
We all know that, right? And COVID really, had a huge focus on what that could do to an older person. And so adult children saying, Mom, Dad, you can't do this anymore. I don't feel comfortable. So we're going to go look at these places. And the imagery used to be, oh man, it's like a nursing home.
Hmm.
That's not what we own. You know,
Yeah.
they're not all super high end. I mean, we're really between the upper middle market and the higher end, but these are all nice places to be
Hmm.
with all the kind of amenities and the activities and the food and all that sorts of stuff. So it's definitely becoming way more of an option versus aging at your home with care.
Yeah. Now, you talked about student housing a little bit as well. And what does that look like? Now, are you working directly with the universities for university sponsored housing, or is it just housing
It's
near
private,
universities? And it could
private.
be students or
Yeah.
maybe not.
No, it's students.
Okay.
I mean, we're right next door. I mean, you're a block or two from students from the campus. These are beautiful properties. Most of our students live better in college than they do post college,
Mm-hmm.
for sure, because mom and dad are paying or they have great scholarship money. And no, these are furnished apartments, all the amenities you can think of, rooftop pools, the fitness center, study rooms. I mean, if you think about like some of the properties are a little different, but they have definitely a hospitality orientation, like the space making. A lot of them have like a little mini coffee shop in the first floor. It feels sort of like, you're walking into an Edition hotel
Mhm.
or Soho House. I mean, it feels good. There's plants and natural materials and rugs and art and books. It feels like that.
Mhm.
And so not only parents like it because their kids are in a nice place, it's safe, but the kids love it because they think they're living this, sort of this hospitality oriented life with their parents paying for it. Look, we're definitely, we're encouraging, not directly but indirectly, you know, through these properties, the entitlement class. Like these are really nice places, but the demand is significant. Our rent growth has been, sort of similar to senior housing, 6 to 12%. Um, and again, these are at these big campuses that have way more demand than supply.
Mhm.
So when you think about University of Michigan, Wisconsin, Tennessee, Florida, Indiana, like a lot of enrollment increases from all over the country.
Yeah.
So that's when you feel like, hey, do I sleep well at night investing in this stuff,
Mhm.
right? It's cash flow oriented with the growth over time, that I'm not going to wake up one day, look at my statement and be like, what the hell happened? How did this fall off the cliff?
Mhm.
That's not what we do here, right? We do things where your range of outcomes is super narrow. Like we can't control interest rates, we can't control what happens in the world, but what we can control is investing in these places where you have built-in moats, you have built-in protection against, you know, occupancy decreases or demand decreasing, those sorts of things. So anyhow, that is our underlying thesis, and we do it through our equity funds. We lend money to these same groups at a lower, obviously as a loan, you're not at equity level, you're at anywhere from 60 to 70% loan to value.
Mhm.
You're generating, 12, 13, 14% returns for being in a loan position. That feels really good from a risk adjusted return profile perspective.
So are the funds that Kane Anderson have out there, are they a combination of both debt and equity? Are they focused
Separate.
just,
They're
yeah,
separate. You have equity funds and then you have debt funds, but they invest in the same
project?
sectors, not the same project, but the same sectors. We wouldn't lend to ourselves, but we do focus on the same sectors because we have significant expertise here,
Mhm.
right? So think about this. If you're a lender, not like a bank, or if you think private credit, people talk about the word private credit, but that's a lending business
Mhm.
that lends in businesses that you have a whole team on the equity side. So think about that advantage, the knowledge, the market intel, right? The operating expertise, all those things that you can benefit from in case things don't go as well, right? And we need to be more involved on the debt side, right?
Mhm.
So that's part of the downside or protection orientation is we're going to lend and buy debt in where we have an equity expertise. So it just underpins our whole philosophy of how do we how do we generate these outsized risk adjusted returns through our expertise, our experience, our knowledge to focus on a few things versus a lot of things.
When you think about the landscape of opportunity, and I know Kane Anderson is always looking for new ways, bringing new things to market. In fact, we got connected because I had been interested in workforce housing.
Yeah.
Where are the newer areas of opportunity you're seeing today?
Well, one, you're right, our attainable housing business where we build and buy value add properties throughout the country in cost burden markets. We love that business. The thing that is really important about anything we do is having a relative value aperture. So when you are a single sector business or you do one thing, you give money to people who do one thing, they're going to figure out a way to justify doing that one thing.
Mhm.
And it's just human behavior. They're not bad people, they're not bad investors, but it's hard if you only do one thing.
Mm-hmm.
And so you have more of a beta outcome. When you're a generalist, you're sort of a beta again, these are generalizations, of course. There's aberrations to these rules or these things that we observe in the real estate world. But last 15 years has been the high tide, lifting all boats, sort of post GFC. Now differentiation, performance, post 21, post COVID, it's really starting to take form. And then you also have the generalists who are beta outcomers,
Mm-hmm.
and so that's not bad. Investors need beta also, but our view is we're going to endeavor to continue to be alpha producers, and this relative value thing is real,
Mm-hmm.
so that we don't do 20 things, we do 5 or 6 things, right? And so these, like, okay, what's more attractive? A student housing acquisition, multifamily acquisition, medical office, senior housing, et cetera, right? And it's where you're buying it at and the rent growth and then the risk of all of that happening. And so there was almost 8 years we did not buy a single student housing property. Almost 8 years. We started buying again really after the Fed increased rates a bunch because pricing moved on the whole market materially. So all of a sudden, instead of building, leasing, selling, we're now buying again because the pricing is more attractive. But if we were only a student housing business, we would have bought in all of the time periods,
Mm-hmm.
right? Because you have money there, it's got to go do something. And so that relative value aperture has been really helpful as we're moving in and out of these sectors, buying, building, depending on the highest risk adjusted returns. Same thing with debt. We buy debt, we make loans across those sectors. Multifamily, we didn't do a deal for almost a year and a half in multifamily because the pricing didn't make sense.
Mm-hmm.
Anyhow, the long story short is when you think of things in this relative value aperture, then you can assess risk adjusted returns honestly, intellectually, and also what you're trying to achieve pursuant to your mandate.
Mm-hmm.
So if it doesn't achieve the mandate, at or above what you've marketed to your investors, you just don't do it.
Yeah.
Right. And so as a result of that being embedded into our not only our philosophy, but into the mindset of every investment professional here, we've made better investment decisions. We've been patient and disciplined. And so today, we're able to buy the things that we're talking about: student housing, medical office, senior housing. Light industrial is very interesting with onshoring and e-commerce.
Mm-hmm.
Fragmentation. There's not that many, there's smaller deals. So you don't have big competition from the big guys, right? So those sorts of things we're going to continue to lean into. What we're not going to do is go out of our comfort zone because there might be something interesting that we don't necessarily have an expertise today. We think today is where you keep it simple, you stick down the fairway, you let the market come to you, right?
Mm-hmm.
Because if you've got capital, you have more capability and a higher likelihood to outperform because the market is dislocated. The market is less liquid than it was, in 2021. So a lot of it is not, hey, let's go do these new shiny things. It's, hey, we've been doing this thing for 10, 12 years. Let's just continue to stay and work these assets, work these sectors long and short. So opportunity fund, core fund, debt and equity. So up and down the capital structure, right?
Mm-hmm.
But stick to what we really know. We're the experts here. This is where our highest risk adjusted returns are.
So we've talked a lot about the different sub-industries across real estate that you guys have specific expertise in. Are there geographical areas that you focus on? I know you have offices everywhere. I believe you're in Boca, right? But you have offices in
We're in South
LA,
Florida, yeah.
New York, and so on and so forth. So is there specific geographic regions that you focus on? Or if not, are there specific geographic regions today that are particularly attractive?
It's really where there's demand.
Mm-hmm.
And so, you look at Knoxville, Tennessee, right? Knoxville, Tennessee has the University of Tennessee, right? So obviously from a student housing, we like Knoxville a lot, right? But are we going to be, investing in senior housing there? Probably not, because it's probably too thin of a market, right? But from a general perspective, you look at the smile, right? Where the sun is, where plus the major cities, that's where we are. We're cautious in California because of the regulatory environment in housing. We're cautious in New York City for the same reason. But we are looking at where there's in migration, deep demand roots, structural demand tailwinds, so that, when you think about like this one horse town idea, or hey, we've got a lot of out migration issues like some places in the Midwest, we're not we're not looking for places or looking at assets in tertiary markets. We really want that embedded depth in a marketplace, but it's really throughout the country, but really focusing on in migration places.
I think that one of the benefits of Kane Anderson is that you guys have a tremendous team. You have multiple office locations across the country that allows for you to be able to do that. I mean, that's a lot to ask if you don't have the resources, and I think that is a major benefit to you. In real estate, people tend to stick on the coast, and you guys have, as you pointed out, University of Michigan, University of Wisconsin, University of Tennessee. But also, if you're focused on senior housing, you're going to go to where you typically get senior migration. So Boca Raton, Scottsdale, Arizona, those tend to be the areas.
Carolina, right? Carolinas, Colorado, those sorts of places.
Exactly. So I want to kind of flip it a little bit and ask you a question you might not have expected me to do. But I'd like to know, as our listeners and our viewers tend to be advisors and folks that are considering these types of investments, broadly speaking, for their clients, or individual investors that are higher up on the sophistication because they're looking at private market opportunities. If you were somebody sitting in their seat and evaluating different types of operators in the space, what are the 2 or 3 questions that you would recommend that they make sure they ask? And then the 2 or 3 things that they really want to focus on when considering these opportunities to make an investment?
Yeah, number one thing is investment behavior. So to determine an investment manager's investment behavior, you look at the years that investment manager is investing. And if you look at 2021 and part of 2022, this is sort of an easy way to it's not conclusive, but it's certainly an indicator. If that investment firm had very active years in 21 and 22, you sort of have to question, is this investor going to be discerning enough to invest in markets where there's a lot of money and pricing is very rich, or do they have enough discipline to be patient to wait for markets that you can have a much more attractive cost basis, risk-adjusted return profile, et cetera, right? So if you give people money, generally they will put it to work. And that sort of basic human behavior principle was illustrated during that time period. So that's number one. If they did, you should dig deeper, because if you give them money, no matter what the environment is, they're going to put it to work. Again, these are not conclusive, but it is an indicator for investment behavior. That's the number one thing. The other thing is, do they do a lot of things sort of well? Are they, sort of like the jack of all trades, or are they masters of one or some? Now, I think, single sector funds are just tough because what we talked about before, but doing a handful of things really well and doing it for a long period of time, that is helpful. Now, again, these are not dispositive, but they are indicators on, the likelihood of having, success over time, not just, pursuant to whatever the beta outcome was in a given vintage or whatever. So those are 2 important things to discern, whether or not you have a higher likelihood of manager outperformance versus beta performance. And then I think the last thing is, are they gritty folks focused on the business? They have an operational component. They're like those sorts of things. Or are they allocators? If they're allocators, you're more likely to beta. versus operators, specific experts, you probably have a higher likelihood of being an alpha performer. And those are three things that I would share as sort of indicators of other managers' ability to outperform throughout markets.
I think that's really, really interesting. And I love the 21-22 example that you gave. I always like to, it's a little harder, obviously, with funds like the type of products that Kayne Anderson puts out, because they don't give traditional performance in the way that a lot of our advisor clients are used to, where you get like a monthly NAV and then you figure out like the NAV change. You're looking at things where you're looking at MOIC or IRR, and
you do quarterly, though. You can look at quarterly. We can always help with the illustration of performance.
And it's just hard to find benchmarks. So that's where, Bonrian can come and help advisors, and your team is available to help advisors kind of evaluate the landscape and have some sort of way to benchmark to make these decisions. I think that's really the hardest part that advisors and their clients face. Unlike institutional investors, they don't necessarily have access to all the tools that can help them evaluate the deals. So having a couple of things that they can look at themselves, like you just gave examples of, to evaluate just up front and ask good questions, I think is really helpful for our audience, for sure. Is there anything I missed? Anything that you want our audience to kind of leave with as kind of we wrap up and think about ways that they can consider this space?
No, I just would say the last thing is, particularly for real estate, you could do better than the public market options.
Oh, that's for sure. I fundamentally agree with that. I always say REITs have their value for sure, but they're still trading on public exchanges. They still are very much equity beta. So you don't get the full benefit of private real estate where you're actually going in directly on these deals. Well, I completely agree with that. Where can our audience find more information about Kayne Anderson and some of the offerings you have today?
Well, certainly our website, and then I don't know if Carrie Brenner provide. I don't know how that happens here, but we can provide like our investor relations contact information.
Absolutely, I can absolutely put Carrie's information in the show notes for sure.
That'd be great. So contact Carrie.
Absolutely. But I think overall our audience learned quite a bit that we haven't really delved into in any of our previous episodes as it pertains to real estate. And for anyone that's interested, Kayne Anderson is one of the leaders in this space. And I was familiar with them long before they became a partner of Bonrian, first for your MLPs and then second for your real estate. So anybody who has questions or is interested in learning more, we'll put that in the show notes. And you can always reach out to the Bonrian team and we can help put you in touch with the folks at Kayne Anderson. Thank you for your time, David. I really appreciate it. Again, for your patience. Everybody, that is it for us today. Remember to like and subscribe. And if there's a specific topic or individual that you think would be interesting for the show, let us know. Leave your suggestions in the comments. We really appreciate your feedback. And with that, that's it for this episode of What's the Alternative? The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Bonrian Capital Management's platform. As such, Bonrian may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Bonrian Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Bonrian Capital trademarks mentioned are owned by Bonrian Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.